Hello, trader. Steve Gans here, and I've gotten a couple of questions in the YouTube channel about when do I do a hedge? How do you know when to hedge? Of course, no one knows when to hedge. No one knows where our markets are going for sure. But there are some things to look at on a somewhat regular basis, and I did get that question again here this last week. So let me kind of show you some of the things that I tend to look at that help me decide when it might be time to consider a hedge. Right now, for example, we've had a massive, solid up move. It has blown through what I would have considered to be prior resistance areas. It's just blown right through those like they weren't even there. That could happen again. I have to understand that. I have to recognize that. That all said, we've been pushing on this Bollinger Band, the upper end of the Bollinger Band here for a while. We are coming into yet another resistance area that is close to all-time highs. I'm also seeing that our RSI, the Relative Strength Index, is pushing 70. And again, 70 is a point that many times, if we look at the past times this has hit 70, it is times when the market has in fact stalled and even rolled over a little bit. So those are some possible indicators. Of course, the news is currently baked into our, what I consider to be this run of the market, the news of we've reached what could be trade agreements with different countries, etc. But now that is baked in, what happens if one of those trade agreements goes sideways or something else changes? I think all the good news from my perspective right now is largely baked in. I think any bad news could put us back moving down a little bit. The other thing here is that our volume on these up days is diminishing. That also shows a little bit of maybe an exhaustion of buyers where the people that were going to buy have already bought, and there may not be as much buying coming in. So these are all things that I look at that say, maybe it's time for a hedge, but where do I want that hedge? I'm going to show this in SPY, so let me just put SPY on here instead. Of course, SPX is the same thing, just 10 times larger. But in my opinion, I think SPY is unlikely, at least in the near future, to pop above, let's say, 610. If I wanted to design a hedge trade around that, the things that I would consider doing, let me just move this out of here first. Let me just exclude this. So my initial goal is I want to hedge. Logical way to hedge is to buy puts. So where do I want to buy that put? I chose down here at the 560 mark. Again, I could slide that anywhere, but I think coming back and looking at our markets, that 560 is a place where if we pull back, we might stall. But if we start pulling back and we get anywhere close to that range, the value of this put is going to elevate because the volatility is going to increase dramatically. So that is going to cause some additional elevation in the price of this put, this long put, that I will then be able to sell at a premium price to somebody looking to protect their portfolio. I like dealing in those nice round numbers as well. Those are the numbers that people gravitate to when they're in a panic and they're like, oh my gosh, I got to buy something to protect my portfolio. What am I going to buy? And they rush toward those types of trades. So looking at that, I'm going to buy the 560, but if I just buy that 560, I have some risk of decay. Let me take this back, and I'm going out here to July 18th. I'm thinking if we're getting a pullback, it's going to happen by then. So this is going to be my P&L diagram right here, right now. But of course, if I don't do anything with that, and that just decays over time and our market stays above where I buy that strike, I'm going to lose $631. What if I want to find a way to pay for buying that put? If I don't think SPY is going to go above 610 between now and July, I could go ahead and sell some calls in that area. Now, I chose to give myself some buffer. I went all the way up to 625. And let me bring these back in. I'm going to include these now in the P&L diagram. So now I'm selling two 625s, and I'm using that premium. You can see that I'm getting whatever it is here, $330 for each of those. So I'm going to be taking in roughly $660, somewhere in that range. I'm using that to buy one of these puts. So that gives me a P&L diagram that at expiration looks like this. If we expire anywhere here below that 625 range, I'm going to end up with a profit of about $27. I'm not looking to make a profit if I end up in this range. And that's not my goal or my objective. My goal, my objective, is to have on a hedge that will protect some of my losses that I would experience in my long-term buy and hold account if that market were to tank back down here a little bit. So everyone needs to look at what it is they're wanting to hedge. Maybe you're just doing this for a trade that you think could be a profitable trade. That's perfectly viable too. I personally tend to do these to hedge long-term buy and hold positions that I don't want to panic out of. In other words, some Google, some Apple, some Microsoft, some Johnson & Johnson, whatever it is that I'm going to hold. If the market sells off hard, those are going to probably sell off hard. And I'm fine with that. Those are companies I like, I want to hold long-term. But this allows me to potentially have some profitability in this trade to offset the losses that I might be experiencing in those if, in fact, we get a sell-off. If we don't get that sell-off, if we stay somewhere between this 625 and 560 or so, okay, it didn't really cost me anything at the end of the day. Now, what I need to be aware of, though, is in the meantime on this curve, let me enlarge this a little bit here now. If we do, in fact, get a big move up in the market, this is going to show some loss here in the meantime until I get to expiration. I have to be aware of that. I have to understand that. I have to be prepared for that potentially happening. So that's the risk in this, is that I need to also not panic out if this starts ripping to the upside. But again, if this is moving to the upside, my premise here is that my long-term buy and hold positions are probably going to be making more money than what I might be losing here. And if I hold this to expiration and we're not above 625, I'm going to be just fine. I will have that minor amount of profit in this trade. So with that, I'm going to go ahead. I'm going to save this trade. I'm going to call it a hedge. And I will provide the link in the description down below. You do not have to have an OptionStrat account to click on that link, open it, and model and study this trade. This is a great way. OptionStrat has a free level for people to come in and play with this. So I urge you to click on that link, open it up, see what it looks like. Model something yourself. Come in here and slide these around, change where they're located, and see what that does from your standpoint. Build a scenario that fits your account and your potential needs. So with that, I'm going to check out here. Please subscribe if you find this information to be of value. Give me a thumbs up, and thanks so much, everyone. Take care. Bye.